Hello everyone. In an effort to help you navigate 2026 through all the uncertainty and turmoil that is going on, we have decided to have a session with our fund managers where we discuss the not just their outlook but also the facets on which they are basing their outlook. So in this discussion, we will go through the parameters on which they have based their outlook, and we will, of course, summarize it for you. To discuss the equity outlook, we have with us Mr. Deepak Gupta, who is Head of Research at JM Financial Mutual Fund. He also manages, equity funds and is a senior fund manager here. For debt, we will have Mr. Killol Pandya, who heads the fixed income side of things at JM Financial Mutual Fund. So without further ado, let's jump in.
So Deepak, before we start with the discussion for 2026, let's do a quick recap for 2025. In your opinion, what worked, what didn't work? If you could just get us going with sure.
So 2025 was a very interesting year. We saw this year having meaningful domestic positive macros, be it in terms of interest rates coming under almost 29 basis points. We had tax rates rationalization with GST rate cuts. We saw personal income tax cuts, along with saw improved GDP growth and lower inflation. But these domestic macro factors didn't really contribute in terms of upright performance in terms of stock markets. That largely on account of meaningful FI selling that we witnessed in this calendar year. And I would attribute that to predominantly currency volatility that we witnessed, where INR was amongst the worst performing currency for the calendar year. It depreciated by almost 5.5%. So more than depreciation, it was the volatility of the currency, which swayed meaningfully, which obviously has impacted and dampened the sentiment of foreign investors with such kind of sharp depreciation. Going forward, we hope that things settle down in a meaningful manner. And one trigger for that could be potential India-US trade deal, wherein the President of the United States of America has imposed additional tariffs on many countries who export to US, and India has had to face the short end of the stick and was slapped with 50% tariff. Resolution on the same is much needed for currency to stabilize, which would aid in settling down of FI outflows. And hopefully then market could move to the next trajectory.
Sure. I understand that there is this is how you look at 2025, and that is a perspective that you formed for 2026, which is based on certain questions. You've answered those questions for yourself. Your perspective on that will give our audience also a sense of how we are approaching 2026. So first questions first, do you think the markets are overvalued?
In our view, that markets had a meaningful discount to what they were a year back. A year back, markets, a year back there would be only about 1 out of 10 to 12 sectors which was trading at a discount to its long-term averages. But as on date, almost about 50% of the market is trading below its long-term averages, and hence the market is while the market is not cheap, is definitely cheaper than what it was a year back. And I think valuation should be looked in context of growth. We think that earnings growth rebound is likely to happen in the next 12 months, which therefore justifies for the market to be trading at current levels, and there could be meaningful upside as and when the earnings translate into growth in the coming quarter.
So, Deepak is making a very valid point. You're saying that earnings recovery has happened, but performance is yet to catch up. So, what are you basing that on?
See, that judgment is based on the fact that after the last 4 to 5 of middling quarters, we've had one quarter there we've seen meaningful earnings growth of about 50 to 60% on a YoY basis for NSE 500 index. Now, this growth has to be consistent. We cannot make forward-looking statements, but we do think that if and when the earnings growth continues to be between mid-teens to high teens, we'll see price performance also catching on the horizon.
Right, absolutely. So, but so we're saying that we're seeing initial signs of an earnings recovery. You, as a fund house, declare that you are a growth-oriented fund house, right? Your investment philosophy, etc., is all based on that fact. For you, for a growth investor, is there enough? Are there enough number of stocks available, even with this revival in earnings, even with the current price performance? Do you think there's enough, a large enough universe of growth stocks available for you?
So it's interesting that you've asked this question because we analyze the top 500 companies of the universe, and which includes the top 100 large cap companies, 150 mid cap companies, and 250 small cap companies. And the study is very interesting, and you should note the fact that in each of the segment, be it large cap, mid cap, or small cap, at least 50% of the universe have grown their earnings by more than 20% on a YoY basis. So there are high growth companies available in every market cap.
Yeah.
It's our duty as fund managers to identify those companies already on and invest on them and to take advantage of the earnings growth that these companies will necessitate, which will in turn reflect in the price.
Right. So what you're saying is there's a universe available, but stock picking will become very, very important. Right. With that, I think we've come to the end of questions on which I think a robust equity outlook could be based. You've answered all of those questions. Could you also sum up the view in a few lines so that we have a concise idea of what we are thinking?
So I think we do think that India is at a very interesting juncture currently, given the fact that we have underperformance of about 15 months. We have positive domestic macros, be it low inflation, low interest rates, improving GDP growth, improving consumption trends, a fiscal deficit which is under check. Along with that, we have a thriving capital market. So what is missing is basically FII flows. Currency volatility, and earnings which are showing resilience but not showing consistency. We do think that as and when earnings start showing consistency, currency becomes more stable, FII flows will withdraw, and market outlook should improve in the next 6 to 12.
Thank you, Deepak, for those views. Thank you to all hearing us, viewing us, for taking time out to listen to what we have to say for our annual outlook. We are joined today by Mr. Killol Pandya, who heads the fixed income investment team at GM Financial Mutual Fund. So, coming to the fixed income side of things, Killol, where do you think we stand currently in the rate cycle?
So with 125 basis points of rate cuts behind us, we are clearly at a mature level in the rate easing cycle now. So while the high growth trajectory and the low inflation environment is providing elbow room to RBI, clearly there are more rate cuts behind us than in front of us. So we are at a very advanced or mature stage so far as the rate cycle is concerned, and navigating in such times is the art of managing debt funds at this point.
Certainly, and we are very well equipped in that sense. So we're coming to the end of the annual outlook, and what are those thoughts the final thoughts that you would want to leave the investors with?
So with 125 bips behind us, like I said, there is still some elbow room. We are in a sweet spot right now. The growth trajectory is robust. The inflation numbers are soft. Even the latest inflation print is below expectations and is expected to be soft in the coming times. In the backdrop of ample liquidity which RBI have been providing to the market, we remain confident that the shorter end of the duration curve will do quite well as opposed to the longer end of the duration curve. In that context, mutual fund categories like the money market funds, low duration funds, and short duration funds ought to do quite well for themselves as compared to funds which have a longer investment and a duration horizon. Overall, we remain constructive on the bond markets. We are in a mature cycle of rate easing, and at one point we will be followed with a pause. But there is a way to navigate such advanced cycles. And we believe one of the ways to navigate that cycle is to gradually move from a duration-based fund management style to a strategic move towards accrual and duration. That is, I think, the way forward and the way to manage advanced or a mature rate easing cycle.
There you said it. It's going to be a mix of duration and accrual play this year. And all the best to you for navigating through a slightly challenging environment. And thank you everybody for taking time out to go through our annual outlook. Thank you, Killol, for sharing your thoughts with us. Very happy New Year to all of you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.